Every single day, millions of Americans deposit their paychecks into a bank account and assume their money is sitting there, waiting for them. It isn't. The moment your money hits your bank account, the bank lends most of it out to someone else. Not some of it. Most of it. Under a system called fractional reserve banking, your bank is legally required to keep only a fraction of your deposit on hand. The rest, it's working, just not for you. Here's how it works. You deposit $10,000. Your bank keeps roughly $1,000 in reserve. The other $9,000 gets lent out as a car loan, a mortgage, or a business line of credit at interest rates that can run anywhere from 7% to 24%. The borrower pays the bank keeps the profit. You earn 0.08%. That's not a coincidence. That's the business model. And here's what makes it more striking. The bank isn't just lending your money once. Through a process economists call the money multiplier, that same $9,000 gets deposited at another bank, which lends out 90% of that, which gets deposited somewhere else, and so on. Your original $10,000 deposit can generate up to $90,000 in new loans across the banking system. The bank profits at every step. Your cut is pennies. The fix isn't to stuff cash under your mattress. It's to understand exactly how the system works so you can position your money to work the same way the banks does. And that's exactly what the next 7 minutes are going to show you. Okay, let's follow your money a little further. Your bank takes and deposits your money and classifies them as liabilities on their balance sheet. That's right. To your bank, your savings account is a debt they owe you. Your money in their accounting is a liability. Now, here's where it gets interesting. The bank then turns around and issues loans. Those loans are assets. The spread between what they pay you in interest and what they charge borrowers is called the net interest margin. For the largest U.S. banks, that margin runs between 2.5% and 3.5% on average. On tens of billions of dollars in deposits every single year, J.P. Morgan Chase reported a net interest income of $89.3 billion in 2023. That number is built almost entirely on the difference between what they pay depositors like you, close to nothing, and what they charge borrowers, a great deal. But lending isn't the only way your bank makes money from your account. There are 3 other revenue streams most people never think about. First, fees, overdraft fees, monthly maintenance fees, wire transfer fees, out-of-network ATM fees. The Consumer Financial Protection Bureau reported that U.S. banks collected over $15 billion in overdraft and non-sufficient funds fees in a single year. That's $15 billion extracted almost entirely from people living paycheck to paycheck. Second, interchange fees. Every time you swipe your debit card, the merchant pays your bank a small fee, typically between 0.5% and 1.5% of the transaction. You never see it. The bank collects it silently on every single purchase you make. Third, your data. Banks sell aggregated, anonymized spending data to third-party financial institutions, hedge funds, and research firms. Your spending patterns, where you shop, what you buy, how often, have commercial value. The bank monetizes that too. So to summarize, your bank earns interest on your money, charges you fees to access it, collects a cut of every purchase you make, and sells data about how you spend it. You earn 0.08%. Now, here's where most personal finance advice stops. It tells you the system is unfair and leaves you there. This is where it gets useful. The bank's entire business model depends on one thing, your inertia. The less you move your money, the more they profit from it. The moment you start moving your money with intention, the equation shifts. Move number 1, stop letting your idle cash sit in a checking account. Move everything beyond 1 month of living expenses into a high-yield savings account. As of 2024, the best HYSA rates were sitting between 4.5% and 5%. On a $25,000 balance, that's the difference between earning $20 a year and earning $1,200 a year. Same money, different accounts. 4 minutes to set up. Move number 2, use the bank's own lending logic against them. The bank profits by borrowing cheap from you and lending expensive to borrowers. You can replicate this in your own portfolio. Series 1, Savings bonds, treasury bills, and money market funds all allow you to lend directly to the government at rates that track or beat inflation. You cut the bank out entirely. Move number 3, understand the float. When you pay a bill, there's a gap between when the money leaves your account and when it clears. Banks exploit this float to earn additional overnight interest on funds in transit. You can do the same thing by keeping your bill payment account separate from your spending account, funding it only on the day payments are due, and keeping the balance invested in a money market fund the rest of the time. Move number 4, stop paying interchange fees on your own money. Use a cash-back credit card for every purchase you already make, paid in full every month, and collect 1.5% to 2% back on spending you were going to do anyway. You turn the bank's interchange revenue stream into your own. None of these moves require more income. They require redirecting money that is already moving through your life. Here's the part that doesn't get talked about enough. The wealthy don't have a fundamentally different relationship with banks than you do. They have a fundamentally different understanding of what a bank is, and then they use that understanding to negotiate. At a certain balance threshold, typically $250,000 or more, banks start offering what's called private banking or wealth management services. The fees get waived, the interest rates on loans drop, access to treasury-backed investment products opens up, the bank stops treating you like a depositor and starts treating you like a partner. But here's what most people don't realize. You don't need $250,000 to start playing by different rules. You need to understand 3 things the wealthy understand that most people don't. First, cash is a position, not a destination. The wealthy keep only what they need liquid, typically 3 to 6 months of expenses, and deploy everything else into assets that generate returns. Cash sitting idle is a choice that costs money every single day. Second, debt is a tool, not a trap, when used correctly. The wealthy borrow at low rates against appreciating assets and invest the proceeds at higher rates. This is called leverage. The bank does this with your deposits every single day. The difference is they understand the spread. Most people borrow at high rates against depreciating assets, cars, credit card balances, and pay the spread to the bank instead of collecting it. Third, the relationship matters. Banks give their best rates, their lowest fees, and their most flexible terms to customers who consolidate their financial relationship. If you have a checking account at one bank, a savings account at another, a mortgage at a third, and a car loan at a fourth, you have no leverage with any of them. Consolidate strategically and negotiate explicitly. Ask for fee waivers. Ask for rate reductions. The worst answer is no. The bank has been playing this game since the day you opened your first account. The rules have always been the same. You've just never been told what they are. Your money is working right now. The only question is whether it's working for you or for them. Here's exactly what to do this week. Move 1. Open a high-yield savings account today. Transfer everything in your checking account beyond 1 month of expenses. You will earn 50 times more interest starting immediately. Move 2. Set up a separate bill payment account funded only on payment day. Keep the rest in your HYSA, earning interest until the last possible moment. Move 3. Audit every fee your bank charged you in the last 12 months. Call and ask for a waiver on each one. Banks reverse fees for customers who ask. Most people never ask. Move 4. Replace your debit card with a cashback credit card for everyday spending. Pay it in full every month. Collect 1.5% to 2% back on money you were already spending. 4 moves, no new income required. The bank has been running this playbook on your money for years. Now you're running it too.